So before we get to the profit ratios, let's quickly run over the financial statements and in particular the profit and loss account on the basis of which these ratios are calculated. All companies must submit their annual financial statements with the Registrar of Companies, and in addition, listed companies must submit them on a quarterly basis with the stock exchanges. The financial statements include a statement of the profit and loss account for the period, the balance sheet, and the cash flow statement. Now, profit and loss account statement shows how much the company earned and spent during the year. If you look at a profit and loss account statement, you will see at first the company discloses the total income from operations. Out of this, we deduct the total expenses, and these are just the expenses related to the operations of the business, such as purchase of raw materials, payment of salaries, maintenance charges, etc. And by doing this, we arrive at operating profit or loss, or income which is purely generated from operations. And that's why we look at this journey of numbers as the operational journey. After this point, you see most of the items are not related to conducting the pure business of the company. There is depreciation, which is an expense which gradually and over the years reduces the value of a capital asset purchased in an earlier period. There is interest expense or finance costs, which is what you pay to the bank for using the money which they have loaned to you. There is other income, which is income generated from sources other than operations, like sale of a building or sale of securities during the year, or any windfall gain which the company makes. Then there are the taxes which you pay to the government in case you make profits. And finally, there are entries to adjust the share of subsidiaries and associates. Now, once you have this flow of numbers clear in your head, calculating these ratios is fairly simple. The formula for operating profit margin ratio is operating profit divided by total sales, and total sales is the same as total income from operations in the first line item, multiplied by 100. Now this expresses in percentage terms the portion of sales revenue which remains after incurring all operational expenses. Similarly, net profit margin ratio is profit after tax divided by sales or total income from operations multiplied by 100. And this expresses in percentage terms the portion of sales revenue which is left for the shareholders. To brush it up again, operating profit margin ratio is the proportion of revenue remaining after paying for the costs of operating a business, such as labor costs, raw materials, selling and administrative expenses, etc. Net profit margin indicates what is left for the owners as a percentage of total income or sales after accounting for all other costs such as depreciation, finance charges, taxes, and exceptional items. Now, just one small point to keep in mind. When calculating the net profit margin on a consolidated basis, the numerator is profit after tax, but before minority interest and share of associates. This is because total income from operations in the denominator represents the income generated by all the constituents of the company, including the minorities. Let's see this on the profit and loss account. What this means is that in case of net profit margin ratio, the numerator is this PAT, before minority interest and share of associates, simply because in the denominator, the total income from operations includes the income generated by all the constituents, including the subsidiaries and the associates. So just to keep it consistent, we cannot take the share of profit and loss left only for the shareholders of the company. Think about it, it's simple.